Hello, savvy investors. Welcome back to the Dividend Uncle channel. Today we're tackling a topic that is both hot and cold, Manulife US REIT. This REIT has generated a lot of interest and concern among us due to its tumultuous journey over the past 2 years. The share price has plunged over 59% over 1 year, and 12.5% year to date, creating both potential opportunities and significant risks. At the same time, investors are unsure whether they should get back in the REIT or even perhaps get out altogether. In this video, we'll explore one way you can determine what you should do, and whether there could still be upside for Manulife US REIT despite the substantial risks remaining. Before we dive deeper, I would like to thank everyone for your support so far. The channel has grown tremendously despite it being a faceless channel. Your likes and subscription keeps me going to provide you with useful content, and not just videos which are likely to be popular. Share price valuation challenges. Now let's dive into the complexities surrounding Manulife US REIT, a topic familiar to regular viewers of the Dividend Uncle channel. You may recall that I've discussed this REIT frequently, especially during the turbulent period before their EGM. In typical Uncle style of storytelling, let me bring you back to that time. Manulife US REIT faced a critical situation when it breached its financial covenants and teetered on the brink of insolvency. The EGM was crucial, and I wanted to ensure everyone understood the complexities to make informed decisions. Thankfully, over 90% voted in favor of restructuring the debt, averting immediate disaster. However, the share price has struggled since then, reflecting broader challenges in the U.S. office market. This isn't surprising given the widespread issues facing U.S. office REITs, which have dampened investor sentiment significantly. One major challenge with Manulife US REIT is figuring out how to value it accurately. Normally, we might rely on current and future dividend yields or net asset value or NAV. Unfortunately, with dividend payments paused due to an agreement with lenders, we can't use yields for valuation. The NAV is also tricky to assess because property valuations have declined sharply, with an 8% drop in just 6 months, and potential sale of assets at a future unknown price and time. Given these difficulties, let's delve deeper into how we can estimate the future NAV by considering several key events and scenarios over the next 1 year or so. This will help us understand the potential risks and rewards of holding or investing in Manulife US REIT. Decline in valuation prior to sale of Tranche 1 assets. One of the key measures that the REIT will take to lower gearing is the sale of assets. The REIT has classified their properties into 3 tranches, with Tranche 1 assets consisting of assets which are weaker, with highest desire to sell. Conversely, Tranche 3 assets are the best assets of the REIT, and they would like to keep them as core assets. For the sale of Tranche 1 assets, it's important to understand the context of their valuation declines. These properties have experienced significant devaluation, with a decline of 18% in the first half of 2023, and an additional 14% in the second half. This cumulative drop is reflective of the challenges facing these assets and the broader U.S. office market. Despite this substantial decline, I have assumed a further 20% drop in valuation before the sale of the assets. This results in the NAV per unit dropping from the current 33 US cents to 29 US cents. Let me explain why I think this assumption is conservative. Firstly, despite the ongoing pressures in the commercial real estate sector, the valuations over the past few revaluations already take into account steep drops in assumptions, including higher interest rates, suggesting further devaluations may be milder. Secondly, management recently hinted that they may hold off on sales if the market prices are too unfavorable. So this presents a floor to the valuations which these assets may be sold at. Decline in valuation of better assets. Next, let's consider the better performing assets in Manulife US REIT's portfolio. That is, their Tranche 2 and 3 assets. These properties have shown resilience with higher occupancy rates and better rental reversions compared to the Tranche 1 assets. The occupancy rates for these properties remain robust, and they have experienced positive rental reversions, indicating strong tenant demand. Moreover, these assets are located in better performing markets, which have shown more stability and growth potential. These reasons are why the valuations of Tranche 2 and 3 assets declined by a much milder 7% and 4% respectively in 2H 2023. Assuming a further 10% decline in their valuations over the next 1 to 2 years can be conservative. While interest rates in the US have not declined yet, they have certainly peaked since the previous valuation at the end of 2023. This stabilization in interest rates can provide a more favorable environment for the better assets in the portfolio, justifying a less severe valuation decline compared to the more troubled assets. This results in the NAV per unit dropping further from the 29 US cents to 23 US cents. Sale of assets. To reduce the REIT's gearing ratio to 45%, I assume the full Tranche 1 assets and a further sales of part of Tranche 2 properties are necessary. The exact amount to be sold depends on market conditions and the valuations achieved. However, based on my assumptions above, we can achieve this by repaying loans through the sale proceeds of about $700 million worth of properties. This reduction in gearing ratio is one of the most crucial aspects of the restructuring, aimed at stabilizing the REIT's financial position and restoring investor confidence. With this, the NAV per unit drops to 22 US cents. Potential fair value of a simple exercise. In summary, the current NAV per unit for Manulife US REIT stands at 33 US cents. Taking into account a 20% decline in valuation for the Tranche 1 assets and their subsequent sale, and factoring in a 10% decline in valuation for the better quality assets, and sales needed to achieve a 45% gearing ratio, the NAV per unit would further decrease to 22 US cents. If we apply a conservative price to NAV ratio of 50%, reflecting the ongoing challenges in the commercial property market, a potential fair value could be approximately 11 cents per unit. This suggests that the current price still offers some upside potential, even without considering the eventual resumption of dividend payments. The Dividend Uncle's take. Investors, including myself, often find ourselves at a crossroads when it comes to deciding on an appropriate value of a REIT, especially in challenging times like these for Manulife US REIT. In times like this, we should try to find an appropriate valuation method, and guess what? A simpler method may be better to overcome the complexities. Our exercise, while simple and filled with assumptions, serves a crucial purpose. It provides benchmarks that investors can use to make informed decisions. For those requiring a higher margin of safety, applying a larger discount to the computed NAV per unit can be more appropriate. Ultimately, it's essential for investors to conduct their own due diligence, determine the assumptions they are comfortable with, and decide on the appropriate discount to apply to the NAV per unit. But let's not kid ourselves, there is still significant risk to the operational performance of the U.S. office market. The stabilization and recovery are not assured. If there is a full-blown office market downturn, even the conservative assumptions used in this exercise may not be sufficient. Investors must do their own due diligence and decide on the risks they are willing to tolerate, and whether the corresponding returns are sufficient to compensate for these risks. In conclusion, while Manulife US REIT presents potential upside based on our conservative NAV estimates, the road ahead is fraught with uncertainties. The valuation exercise highlights that even in challenging times, there might be opportunities if the market has overly discounted the risks. However, the significant risks tied to the U.S. office market's operational performance cannot be ignored. Investors need to weigh these risks carefully, consider their own risk tolerance, and ensure thorough due diligence before making any investment decisions. Remember, investing wisely requires both a keen understanding of potential rewards and a cautious approach to potential pitfalls.